The sky was falling. It was 2007, and we were in the midst of what is now recognized as the Great Recession. And I was pissed. I'd watched all my investments carefully placed in managed funds by my trusted investment advisor flop. My stance at the time was, don't just stand there, do something. It was a stance that would change over the years as I got more financially savvy and started to allocate my assets in long-term investments that would rise and fall with the economic tides, but hopefully continue to reach new heights in the end. Don't just do something, stand there. Most of us believe that we are staring down a cliff that will soon become our next recession. We have no idea whether right or wrong, or if right, how deep and wide this recession could be. Every one of us at the moment is standing still and waiting to see what will happen. When it comes to our investments, should we do something and pivot, or should we do nothing and stand by our trusty and true long-term asset allocations? I bet my guest today has an opinion. Joseph Hopue graduated from Iowa State University after serving in the Marine Corps. He worked in corporate finance and real estate before starting a career in investment analysis. He has appeared on Bloomberg and CNBC and led a team of equity analysts for a venture capital research firm. He holds a master's degree in business and the Chartered Financial Analyst designation. His YouTube channel, Let's Talk Money, has over 550,000 subscribers. Joseph, welcome to Earn and Invest. Let's start with the basics. Is the sky falling? And if so or not, how do we know?
Doc, it's great to be here again. Thank you for having me. And I never want people to panic out of stocks, and we'll get into that, why that is. We are, in my opinion, and in many's, definitely heading into a recession. We have never been at a point where the Fed needs to draw back so much out of the economy to get the inflation down. And yet employment is so good that it is going to make it so much harder for the Fed to do that. Basically, what the Fed needs to do is bring inflation down from a 40-year high back to the early 80s and into the 70s when we had inflation this high. But it needs to do that while, limiting, kind of tamping down the jobs picture, right? Employment and unemployment. Because as long as unemployment is also at historic lows, wages are rising so fast, and employers are having trouble finding workers, then that inflation picture is going to be so much higher. If you remember back 40 years, well, if some of us remember back 40 years when inflation was this high, then the jobs picture wasn't nearly as good. So the Fed did have a little bit more leeway. Here, they're going to have to be so much more aggressive and raising interest rates so much more aggressively and higher that it is very hard to see how they're not going to choke off the economy and send us into a recession. Now, that said, again, I think the bigger problem is with investors trying to invest into that, making some rash decisions with their portfolios instead of maybe stepping back, thinking about it a little bit more in some of the strategies that we can talk about, really getting the best of both worlds, keeping their money working for them right now, but then saving some aside to get, prices as they do drop.
We're going to talk in a moment about your credentials and what a chartered financial analyst is. But you said something that I want to get a little more granular on. Help our audience understand this a little better. You said one of the big differences between the 1980s and today is both times we had issues with rising inflation. But today, the jobs picture, in a sense, there's much less unemployed than there was back in the 1980s. Why is that so significant?
Well, okay, so the Federal Reserve, the nation's central bank, really determines interest rates, right? They set their own Fed funds rate, and that affects all the other interest rates, right? Corporate borrowing, it affects consumer loans, mortgages, things like that. And they have two mandates, just two things they need to do. They need to keep unemployment low, but also keep inflation low, right? They need to protect the jobs picture, but also protect the value of the dollar with that inflation. And they do this by raising and lowering rates, as well as, buying bonds and some other stimulus measures, but mostly by raising and lowering their own interest rate. And so, when inflation is so high, 8.6%, highest since 1981. And again, some of us remember, us old timers here, but going back into, the 70s where inflation just exploded up and beyond double digits in the United States. But the jobs picture wasn't so great. So what the Fed could do back then, it could raise interest rates, and it wasn't it wasn't terribly difficult to really affect the economy, right? Raising interest rates slowed down consumer spending. The jobs picture was already a little bit weaker, so it slowed that down as well. And they were able to bring interest rates down. And we've had falling interest rates for basically about 30 years, really. The Fed is looking at, okay, the jobs picture is so much stronger. There are something like 11 million jobs open and only 8 million people unemployed looking for jobs. That is causing obviously wages to increase as companies compete for fewer workers. So even as we hear some, especially technology companies, some other companies saying they're going to be starting to lay off people, they're going to start, slowing their hiring, we are still at a very strong jobs picture and very low unemployment. So the Fed is going to say, okay, you know what? We don't have to worry about the jobs picture. We can be singularly focused on this inflation and raise rates as fast and as far as we want, right? Because if the jobs picture is still strong, then they don't have to worry about that part. Also, though, because the jobs picture is so strong, it's going to keep that pressure on the economy and on economic growth. Basically, what the Fed is trying to do, they're trying to slow down the economy. There's no other way around it. You have to slow down the economy to slow down corporate spending, to slow down consumer spending, to get that inflation down a little bit, right? Well, the Fed, their perfect world is where they can slow down the economy just enough to bring inflation down, but they don't slow down, they don't choke the economy, right? They don't send us into a recession, which would be negative economic growth. The Fed doesn't have a great track record at doing that. Okay. If you look back in the past, they've often sent us into a recession. Usually, it can be a mild one, but generally they do send us into a recession, slows the economy down and brings inflation down. Another thing I'm worried about here is that we've never been at this point where they have injected so much money into the economy over the last, really even since 2009 from the financial crisis. We're still working through some of the money they pushed into the economy there, but especially over the last 3 years with the pandemic. Globally, it's been over like $15-20 trillion. Just in the US, it's been $10 trillion plus that the Federal Reserve, the central bank, plus the government has really pushed into the economy to, understandably keep us out of a depression. But when you push so much money into the economy for stimulus and it's got nowhere to go, then it is going to push up asset prices. It is going to push up stock market prices. It is going to push up other prices as well and stoke inflation. And now they have to bring that back. They have to bring a lot of that money that they've pushed into the economy back. And we've just never been at a point where they have to draw back so much money out of the economy. And it is going to affect stocks. We're already down about 20% on that broad stock market index, the S&P 500. The average the average bear market, so the average stock market crash over the last 90 years has been 28%, right? 28% down from the peak, which would mean we'd still have at least, another 8% or so down from the peak. The peak was right around last November. The average bear market has lasted about 9 months, 9 to 15 months on average. Now, the numbers skewed a little bit, though, because some of those stock market crashes in the past have not been followed by a recession. The ones that were followed by a recession, which is, I think, what we're looking at now, have been a little bit deeper and a little bit longer, right? So the ones that have been followed by a recession have been down closer to 35, 40, 45% on average down from the peak, which would mean we have a lot further to go on stock prices as they head lower.
It certainly sounds like our economy is threading a needle. You've just given us a pretty technical analysis. Your credentialing is as a CFA, a chartered financial analyst. Tell us a little bit about that credentialing and what that means.
Sure. A lot of people get it confused with the CFP, which is the Certified Financial Planner, right? And I like to say the CFAs, they work on Wall Street, right? They're financial analysts, it's equity analysts. So they're going to be working as stock analysts for the big banks. They're going to be working for venture capital firms like I did, or private wealth management. So they're generally analyzing stocks, analyzing other investments, putting portfolios together for the highest possible return at the lowest risk. The CFP, that Certified Financial Professional, so whereas the CFA works on Wall Street, the CFP works on Main Street, right? The CFP, that financial planner, they're going to be working with people with their insurance, with mutual funds, with index funds, things like that, just trying to get them to that planning idea in that aspect. Not to say that CFAs don't work with Main Street. In fact, it's the reason why I started on YouTube is to work closer with regular investors and Main Street investors. But generally, it's more of that analyst role and capacity.
So we talked a little bit about your credentialing. You also previously joked about how us old guys remember inflation in the 1980s. You and I have been through a number of recessions and downturns, right?
It has.
There was the early 2000s. There was the Great Recession in 2007, 2008. Tell me some of the things you've drawn from experiencing those recessions as you're thinking about what may happen today.
Well, over the last year, it's really struck me that my experience is really unique in being able to talk to new investors right now, because I started investing while I was in the Marine Corps in 1999. Of course, the perfect time to start investing, right? Because we all know what happened the year after that, right? So I have gone through, I started at the market peak, saw my portfolio just crash and crumble during the dot-com bust. Made all the same mistakes that new investors do before I actually started learning about investments and started, studying for the CFA charter, started working in the industry. And I think it's very similar to what a lot of new investors are going through right now. A lot of new investors just starting out over the last couple of years have seen nothing but higher stock prices. And really, they've been ingrained. They've got that perception that stock prices always go up, and they only go up, and they go up by 15 and 20% a year. They're a little bit disillusioned now because they are starting to come back to normal, what a normal stock market looks like, and those crashes that do come. So, I've seen it all. I've experienced it all firsthand. And I wish I could say I avoided a lot of the mistakes just by, experience and learning and that kind of thing. But I think, our biggest lessons are our biggest, where we draw the best disciplines and the best learning from is from our mistakes and from our pain. And I've got a lot of pain in investments.
I feel like especially new investors get a lot of advice. I mean, how many times have we heard people say, oh, a recession is coming, buy the dip? On the other hand, I hear just another group of experts that say, stick to your financial plan. Now is not the time to change. As he talked about a little bit in my introduction, most of us feel like a recession is coming. How do we know if it's time to wait it out or take action? I feel like this is a pivotal question for us to address as we're looking down at this possible abyss.
Well, it is the question, right? It is always the question of, what do you do now? Where do you see the market going? Should you even try to see where the market is going and changing that plan? I've found that 90% of the time, it is best just for most people just to stick with that plan. Do not stress out over the market. Do what you do best, which is, whatever you do as your 9 to 5, spend time with your family, enjoy your life. Do not worry about the market and what stocks are doing, because it can tear you up inside. What I like to do is, well, one part is for those that need that have that itch, right? To try to analyze the market, to try to pick stocks, to try to do things like that. Have a very small portion of your portfolio, maybe 10% of your money in that kind of idea, in that, okay, this is what I'm going to do with, these are the stocks I like. This is what I'm going to do if the market does this, or kind of that stock picking and investing kind of idea, right? Have just 10% of your money. What that's going to enable you to do is to scratch that itch, to feel like you're trying to get that little extra return. You're trying to do something with your money. And that's going to enable you to keep a hands-off approach to the rest of your money, to that 90% that is still locked in that long-term financial plan that is ultimately going to make you the most money. Just watching your stocks go up, slow and steady over decades in that portion, right? So for those of you that really feel like you need to be doing something, that you have that itch to scratch for stock picking and analysis, do it just with just a small portion of your portfolio. The other side, you've got maybe 50, 60% of your money in just a handful of ETFs, of exchange traded funds or funds that cover the broad asset classes, cover within each asset class, are diversified, going to get you those long-term market returns, right? You don't even have to worry about it. With maybe 30% of your portfolio, maybe you can invest in individual stocks that are also long-term that you still don't want to touch too much. But and just kind of have that hands-off approach with the good portion of your portfolio, right? Because we tend to second guess ourselves. We tend to panic or get overly excited and exuberant and make the wrong decisions. The other thing I would say is, if you are going to be changing your portfolio or making investment decisions, especially around times when it is so stressful right now. We see stock prices crumbling every day, and it is so stressful on people. You need a formal strategy. And that means writing this out on a piece of paper, writing it out on the computer. Again, us old timers, we still write things out on paper, but I know that the kids love the computers these days. Write it out somewhere. And basically what you're saying is, with the cash I have or with the money I'm going to invest to take advantage of these lower stock prices, and that's something I want to cover next, is the real opportunity in these stock market crashes and these recessions. But, this money that I am going to invest or these changes that I'm going to make, I'm going to wait until these points in the market, right? So for example, we said the S&P 500, that main stock market index, is right around 3,900 right now. It's about 20% down from where it was at the peak last November, about 4,800. I'm going to wait until, and this is just an example, you say, maybe I'm going to wait until the stock market does get that 30% down from the peak. It'd be about 3,500, 3,400 on the S&P 500. And at that point, maybe I'm going to invest a third of my money, or I'm going to make some of these changes. I'm going to buy into those stocks that I think are now cheap. But I'm going to save back, another 2/3 or so. And then I'm going to wait until the stock market's down to maybe 3,100 and then do that. And then again, maybe down to 2,800, right? What this does is it starts putting money to work for you quickly, right? So if the market does fall a little bit more to 3,500, you're putting that money to work. So if eventually when that bull market comes around, then you're going to have that money working for you and you're going to make returns on those stocks. But it also keeps some money back for if stocks do continue to fall lower, right? So it's kind of the best of both worlds. You're putting your money to work as the stock market falls, but you're keeping some dry powder back to invest later. It also, more importantly though, it takes that guesswork. It takes the stress out of trying to time the market like this, right? You're not really timing the market. You're just setting points at the market where you're going to make these big decisions. And you're not trying to do it on a day-by-day basis. Because I see so many investors, they watch the market every single day. They stress out, right? It causes the gray hair and the lost hair, which you can see how much I've stressed out. I was about to say,
you nor I have much of that to begin with. But
yeah, I've stressed out already. I had to learn this the hard way to stop stressing about the stock market. But, I see too many investors, they stress out every day. They think, okay, is this the time to go all in? Are stocks at their bottom? Should I invest? I don't want to miss out on it, right? And eventually the stress just becomes too much and they make those rash decisions. They push all their money into stocks. And of course, they just continue to watch stocks go lower, right? And it is just such an unnecessary kind of life, decision there. So what this does, it just takes the guesswork and the stress out of it by formalizing that plan. You have that plan. You're going to stick with it. You don't have to stress out over the market every day. You're going to get the best of both worlds with this kind of a plan.
Two things you said that I want to reiterate. I love this idea of the 90-10 portfolio, right? 90% is more your long-term investments. 10% is to play with. The reason why I love this is with that 10%, you can strike out and it probably won't affect your life that much. On the other hand, if you hit a home run with that 10%, it may have a huge impact on your financial future. Sure. So to me, that sounds like a win-win. I also wanted to say, again, this idea of writing out an investment plan, especially when we become more and more illogical as the stock market goes farther and farther down. So I think it's good to have that written out. There's something about recessions. It seems like everyone I've been through, you have this crop of experts who say, no, this time is different. And it seems like every recession, we get that group of people who says that. Now people are probably saying this time is different for what I can see as at least two main issues. One is inflation, which we talked about a little bit. The other is that we've had such a long-term high on equity returns that people believe that the duration and the amount that equities drop is just going to be longer and harder than we've seen in the past. Tell me what you feel about these two issues. Is this different in your mind than any of the previous recessions that at least we've been through? Can you draw distinct differences that are actionable?
Sure. We always laugh when people say this time is different, right? Because it's kind of the boogeyman in analysis, right? Because they say it's never different. There's always commonalities. Like Twain said, right? While history never repeats, but it often rhymes. Okay, so there are often commonalities, I think, with this one. Obviously, we can make the direct relationship with the 70s and 80s when inflation was so high and the Fed really had to be aggressive to bring it down. Back then, we saw Chair Volcker of the Fed, in fact, spurred what we call now the Volcker moment, where he just crammed interest rates so high that it did choke off the economy. There in 1981, 82, I think interest rates hit double digits, like 12, 13%. So he really did. So we can really see a point where inflation was so high, and what the Fed did about it, and what it did to the economy. Right. And I think that perspective is something that a lot of people are going to have to come to grips with right now. The differences, obviously, again, are what we talked about with the sheer amount of stimulus the Fed and the federal government has pushed into the economy. $10 trillion. We've only got a $20 trillion economy. So basically almost half of the economy was pushed out, into as cash into the economy over the last few years. So that's just, and to see this in action, you only have to look at a stock chart of the NASDAQ, the S&P 500, or many stocks over the last few years. You see a pretty natural progression up 10, 12% a year from 2010 through 2019. We had a really good 2017. 2019 was pretty good, fairly slow sloping. And then something happened in 2020 and stocks just went this way. They just went exponential. It was just super normal growth. And so, anyone that has invested for as long as we have, you just have to look at that and say, okay, something broke, and to fix it, it's probably going to entail some pain. So there are commonalities to this recession. There are differences that I think it could be, a little bit deeper than what we've seen in the past. Now, saying that, again, I want people to take the perspective, kind of a counterintuitive perspective here. I see so many investors get excited, get exuberant, and just love to push money into stocks as stock prices are going up. That's when everyone wants to invest. But then they panic and sell out of their stocks, or they just quit investing completely as stocks are coming down, which, if you think about it, as stocks are going up and you're investing, you never know when that's going to be the peak. You never know when, okay, I bought stocks now at this new high. Is that going to be the peak for this market? Are stocks going to be falling now? On the other hand, as stocks come down, during a stock market crash, these are guaranteed price discounts, right? Because you look at a 100-year chart of the stock market, and I guarantee you, the only thing guaranteed there is stocks do eventually rebound and they do eventually hit new highs. So the only guarantee right now is that you are getting stocks at a discount from their prior peak, from what they were. So this is an undeniable opportunity for investors to invest. Now, again, I don't think you should push all your money into stocks all at once, because I do believe stock prices are coming down. But you do want to invest regularly, keep that habit of investing, invest regularly at different points to take advantage of those lower prices. Another thing I would say is, again, I see so many people just sell out of their stocks completely, swear off investing. Why sacrifice that money? Why put that money, in an investing account if it's only going to lose money and you're not going to be able to spend it, right? So a lot of people just stop investing and say, I'll come back when the market's back. Of course, they wait too long. They wait, 2 or 3 years after the bull market has started, and they've missed out on a lot of the gains. These bull markets, when a bull market does start, it tends to be, 15, 20% in those first years, and a big portion of the entire bull market. So people just wait way too long to get back in there. Plus, they've stopped investing. They're now using that money to buy Mocha Coca Frappuccinos at Starbucks, right? To buy, the other essentials like Pop-Tarts and things like that. And their expenses have crept up with that extra income, right? You have that income creep that gets us all, where you all of a sudden have a little bit more money to spend, and your expenses kind of creep up to match that, right? So what happens is, when they do want to start investing again, it's very difficult. It's difficult to find that extra money to invest, right? Because your expenses are now much higher. So I would just say, just keep investing, keep that habit of saving, putting money into your account. That doesn't necessarily mean you have to buy stocks with that money that goes into your investing account. You can keep it in cash and wait for those different points in your strategy. But definitely keep that habit of investing, of putting money into your stocks, because it is going to make it so much easier to take advantage of those lower prices when they do come around. And it's going to make it so much easier to to just keep investing and enjoy what is really, what Einstein called the eighth wonder of the world, that compound interest. Actually, it's interesting that what time does to your investments. I saw a statistic last week that I just love. Warren Buffett. Everybody knows Warren Buffett. At one point, the richest man in the world, something like, over $80 billion right now, and about 80 years old. He has made more money since he reached 65. Started investing when he was about 15, right? So he had about 50 years of investing, before he reached 65. He has made more money since he was 65 than he did that entire 50 years preceding, right? And it's just the power of compound interest. He had something like $50 billion when he turned 65. And if you make just 10% on $50 billion, that's $5 billion a year. So you really start to see how that money, that because you're keeping that habit of saving, of investing every single month, and you just let that grow over time, you really do start to see how that power of compound interest, of that money, making money on itself every single month, every single year, really does add up.
I love the message that we have to keep investing, especially as the stock market is going down, keep investing in equities, because long-term, that's probably going to give us the best returns. Help me understand a trend that's currently driving me crazy. All I hear is people talking about I-bonds. I-bonds.
Oh, I-bonds. Okay.
And while I get that there is a good return, it's an inflation-based return, so it's not as good as the actual just naked number is.
Sure.
I feel like we're missing part of the narrative, and people are taking their money that was allocated for equities and deciding to throw it into I-bonds because they think it's safer. Tell me, is that a mistake? Am I right to be annoyed by this trend?
I mean, there are trade-offs to it, but I do think it is one of the best opportunities for investors right now. You're limited to $10,000 each person. So it's not like, someone can take all their money, generally all their money out of equities and sell everything and really leave the market. So now with I-bonds, okay, so they set the rate every 6 months. Right now it's 9.6%, which is an amazing rate for any kind of a safe bond investment. You are locked in for a year. You cannot sell for a year, which I think we're going to need that kind of protection, capital protection for maybe even longer than a year. But I think a year is really kind of the minimum. And for that amount that you want to protect, if you do sell before 5 years, then you give up 3 months worth of interest, right? So that 9.6%, or wherever the interest rate does go, then that is calculated on a monthly rate. And you give up 3 months of that, which, if you hold them for 18 months, year and a half, then it is still going to be a very strong, very, very good interest rate on that investment. So I would say, it's a great way to protect your money. Basically, it is a savings bond. So it is guaranteed, backed by the full faith and credit of the U.S. government. I kind of hear some snickers out there, but if the U.S. government stops paying on its savings bonds, we're going to have a lot more problems than just money and, the financial markets. It's going to be, grab your Pop-Tarts and head for your shelter. So they are completely safe. As far as, I wouldn't tell people to sell out of their stocks to invest in I-bonds. I would say, take any of your free cash, any of your cash investments or anything like that and invest, or, you can invest in I-bonds as often as you want. Every month you use that money from your paycheck to buy a little bit more in your I-bonds account. There's no fees if you use treasurydirect.gov to invest, to buy directly from the treasury. So I wouldn't necessarily sell out of your stocks because, of course, you're selling at a loss, the market down 20% already. But you do need some protection, against further losses on the market. And generally investors are just so underexposed to those safe kind of investments like bonds, like other diversifying investments like real estate and other alternative assets. So, it really does, a lot of investors really do need to start adding some exposure to some of these safer investments. Preferably it would be when the market is rising, so you're not selling stocks at a loss, but definitely getting in that diversified portfolio kind of idea.
We are talking to Joseph Hogue. He has appeared on Bloomberg and CNBC and led a team of equity analysts for a venture capital research firm. He holds a master's degree in business and a chartered financial analyst designation. We are going to take a short break. I'm Doc G, and this is the Earn and Invest podcast. Hey, everybody. I am incredibly excited to announce that my book, Taking Stock, A Hospice Doctor's Advice on Financial Independence, Building Wealth, and Living a Regret-Free Life, is now available for pre-order on Amazon or wherever you buy books online. That's right, the book officially drops August 2nd, but you can order it now so that you receive it right then and there on the day it launches. The easiest way to do that is to go to earnandinvest.com/preorder. Again, that's earnandinvest.com/preorder. And it'll give you a chance to take a look at this book, which is the culmination of all my experiences in personal finance and financial independence, with my experiences as a hospice doctor dealing with the terminally ill and what they have taught me about their regrets, about life, and yes, even about money. I can't wait for you all to get a chance to read my book. I've been working on it for years, and it's all coming to life. Order it now for pre-order, and you'll get it on August 2nd. Now back to the show. Let me reintroduce you. We are talking to Joseph Hogue. His YouTube channel, Let's Talk Money, has over 550,000 subscribers. Joseph, right before the break, we were talking about increasing the bond allocation or safer allocation, especially in more stable times when equities are rising. So obviously we don't have to take on a loss on them to sell them and then put them into safer alternatives like bonds. What's interesting is this has also been a time of the expansion of, in general, the alternative investment marketplace. I feel like there are more alternative investments than ever. I'm not just talking about crypto. There's crowdfunding of real estate. There's crowdfunding of farmland. There's syndications of all sorts of things out there. There's securitization of artwork. Talk to me about the role alternatives play in general in a well-diversified asset allocation, especially now where things seem so unsure in the stock market.
Well, I think, alternatives can definitely play a role in your portfolio. I don't think most investors necessarily need a lot. I would put this in that 10 to 15% of your portfolio where you're just trying to play around with it. You're having fun with your money, that kind of thing, to satisfy that itch, right? You might have maybe obviously some farmland or direct real estate exposure, or even real estate stocks and other real estate projects within that larger diversified part of your portfolio. But for most people, I don't necessarily think that you need to stress out about the extra returns that you could get from a lot of these alternative assets. Now, that said, I do invest in cryptocurrencies and Bitcoin and Ethereum. I own farmland and real estate, as well as some startup companies in venture capital. But for the most part, I think it's something that investors can do if they want to, if they have that itch and they want to explore that idea and that topic. But it's not necessarily something that you have to feel obligated to learn about. The best thing alternative investors alternative investments can actually provide kind of an interesting conversation piece, for lack of a better word, for your investments, or to make investing fun or interesting or motivating to you. Some of these, like investing in wine. I've started investing in wine over the last couple of years, and it's just been amazing learning about the different regions, the vineyards. Going to wine tastings is always fun, and learning more about wine, just to be able to know more about that investment, right? So it's a great way to motivate yourself in a topic for investing. Farmland as well. Coming, an old Iowa boy like myself, obviously farming and agriculture was a big part of the state economy. So I've always enjoyed, kind of that aspect of investments. And again, as we were talking about earlier, with this 10 or 15% of your portfolio that you have these alternative investments, that you have a little bit more shorter term investments and that trading kind of sense, then you don't need very much, right? If you've got just 2% of your money, or 1.5% even, in cryptocurrencies, and they go tenfold over the next 10 years, that's 11%. That's about 11% return on your entire portfolio just from that 1.5%, right? If you lose that 1 or 2%, it's really not going to affect your overall wealth or your overall path to financial success. It's a great way to kind of get the best of both worlds, get those higher supernormal returns if they do come around, but not totally destroy your portfolio and keep yourself on the path to those investing goals. So that's definitely where I would put those alternative investments. Make sure it's something that you enjoy looking at, you enjoy analyzing, you understand. I think the worst thing you can do is get into some of these, like you talk about syndications, these crowdfunding sites, things like that. Invest in something that you have no idea how it works. You just heard it from the cab driver, from the Uber driver, that it's a great investment. And so you rushed out to put a lot of money into it. These alternative investments, you really do need to understand how they work, want to understand better how they work and follow them, on a year-to-year basis.
You mentioned briefly Bitcoin and Ethereum. I don't want to go all the way down the rabbit hole, obviously, but how durable do you think the crypto craze is? Do you think this is something that's going to be around in 10, 20, 30 years, or do you think it's going to burn itself out?
Well, I think the real staying power behind cryptocurrencies is that blockchain technology, right? We're just starting to see how the blockchain is used in different industries, especially healthcare. A lot of the other industries where you need that decentralized control over it and that record maintenance, right? So the blockchain technology is here to stay. It is changing the way a lot of industries work now. Under that, the way cryptocurrencies work intrinsically. Now, obviously, there's a lot of speculation and investment in cryptocurrencies beyond this, but intrinsically, how cryptocurrencies work is they work as a way to verify changes in that blockchain technology, right? Changes in that spreadsheet, that online spreadsheet that is blockchain. They need these cryptocurrencies to verify each change in those, right? So we do need, cryptocurrencies on top of those blockchains. Now, that said, there are a lot of cryptocurrencies that have no use whatsoever. They're not used in any kind of a blockchain. These blockchains aren't used in any kind of technology or any kind of industry or anything like that. And all you have to do is look at the name for these. You've got the main cryptocurrencies, right, that are used on the main blockchains like Bitcoin, Ethereum, Algorand, things like that. And then all the other ones are in a category called poo coins, right? Shit coins. And so you only have to look at the larger category name to understand these are not long-term investments. These are trading and short-term investments that whether you make them or not is your choice, but they don't have a lot of value behind them. As we do get a huge crash in cryptocurrencies, I think a lot of these coins are gonna die out. They're gonna lose all their value. People are gonna just sell them out. But we will see Bitcoin, Ethereum, and some of those other larger coins, used continuously in that blockchain technology. And this is just something that happens with new asset classes. We saw it in 2017 when Bitcoin fell something like 85% from its highs. It's now down similar. I think it's now down something like 65%. And so it's just that kind of cycle of boom and bust in new technologies, new assets, that kind of thing. But I do think, we will see new highs in these larger coins. We will see them continued to be used in the blockchain and as investments. Besides that, a lot of these coins, the larger coins as well as the stable coins, which peg their value at the dollar, are being used in others transactions as well, as international foreign transactions, because they are instantaneous. They are very low fees. They cut fees for currency transactions as well as corporate, international transfers and things like that. They cut fees by more than half. So they do have a very real and very intrinsically valued in, outside of just somebody and selling them on the investment purpose alone.
When we talk about crypto, when we talk about alternatives, and more specifically, often when we talk about stock picking, what we're really doing is talking about this idea of beating the market. There are basic market returns, and we do these things to enhance those basic returns to maybe do a little bit better. Is that the goal? And especially, again, I want to keep this in mind with the fact that we feel like we're a little bit on a precipice right now of we have a major stock market drop, and we feel like we're on the precipice of a recession. Should our long-term goal be to beat the market here? Or if not, what should it be?
And this is gonna sound crazy coming from a guy who has made his living in finance and stock analysis and finding the best investments and things like that. But no, it should not be your goal. Beating the market, getting those extra supernormal returns should not be your goal. Your goal should be meeting those very specific, unique financial goals, unique to yourself, right? Everyone should have what they're going to do with that money, right? What they're going to do with their money in retirement, for tuition, whatever goals they have. build a mental picture around that. And we're talking a complete story around what you're going to do in retirement, what your days are going to look like, who are the people going to be around you. What that's going to do, it's going to motivate you to keep investing, to keep that habit of saving and investing for that, for that mental picture. But that should ultimately be your goal, just having the money set aside to meet those goals, right? And I think what people generally find when they really do the numbers and figure out how much that's going to cost and how much they need to invest, they don't necessarily need to beat the market, right? They don't need these huge returns. They need an average, 6, 7, 8% annualized return on what they're saving every month and every year to meet and even sometimes beat those goals, right? So I think people people are overcomplicating investing, trying to beat the market all the time and pick stocks when you really don't need to, right? So it goes back to that idea of having a core part of your portfolio. And what I like to recommend is called the core satellite strategy of investing, right? You have that core part of your portfolio, maybe 60, 70% in ETFs and a handful of funds that give you that market return that you don't even have to worry about, right? Because it is so diversified across stocks, bonds, other things. You're getting the market return, no more, no less, and you really don't even have to worry about it, right? You've got another 20 or 30% of your money that you have in some individual long-term stock picks. You generally don't have to worry about those either because they are long-term. These are the companies that you know and love, that you think they're changing the world in which we live in, and they're going to be around for 20 or 30 years, and they're going to get you some good returns as well. And then for that, that 5, 10, 15% of your money, basically that is only there to satisfy that itch. If you feel that need, because a lot of us, we do feel that need to analyze stocks, or we just enjoy it. Like I said, with the wine investing, with farmland investing, with the cryptocurrencies, we enjoy looking at these different investments. We enjoy picking stocks and really, looking at stocks at a more granular level. And if we didn't have that 10% of our portfolio where we were able to do that, we would feel that urge to mess with the other 90%. And we would generally probably mess it up, right? Because we would be trading in and out of those long-term investments and making those bad decisions. That 10% of your portfolio, that is only there if you do feel that need to pick stocks, try to beat the market, and really, get that supernormal growth. But the goal should be with this 90% of your portfolio that is going to get you those long-term returns and get you to those financial goals.
What I love about your answer is often people don't consider the fact that reaching their goals may mean a return that is maybe a little lower than the market. And in fact, when it comes to investing, what we're really talking about is toggling risk and reward. So when you decide your reward can be a little bit less and still meet your goals, it gives you the opportunity to also decrease your risk quite a bit, which leads to a very stable portfolio. And I think that's a really important message to hear, so that we don't keep on getting caught up on this idea, I need to make 10% or 12% on my money, or I have to meet the S&P 500 and whatever it does. And the truth of the matter is, many of us can actually reach our financial goals without having to do that. And we can do it in a much more safe manner, which I think is really important. All this leads me to ask you, you've got the training, you've got the certifications. There are a lot of us out there who are DIYing our portfolios and DIYing our asset allocations. Tell me your opinions of that. I mean, do you feel like your average person is knowledgeable enough to put together their portfolios in such a way that it fulfills their needs?
That fulfills their needs? Yes, I do. I think there is a lot of information out there on responsible portfolio allocation and how to make a portfolio as far as different assets and using that kind of 90-10 split or that core satellite strategy. I think there is the information out there for those people, and it is available. Now, whether they that would be kind of a rational investor, right? And we are not rational because we're human. Okay, so most of us, myself included, we get caught up in these themes and these memes and these these bull market cycles where we do feel like you said, we do feel like we need to get that highest return. We look at Tesla going up 20 or 30% a year, and if our very well planned portfolio of very long-term stocks and very long-term investments to beat our goals, if that portfolio is only doing 9%, even 10% or 11%, which is a great return, if that's not doing that 20%, we feel like we're doing something wrong. we feel like we're missing out, that fear of missing out. And we end up making those bad investing decisions. We sell our long-term investments. We sell out of a lot of that 90% of our portfolio that is working for something that may or may not work, or something that is so much higher risk. So I do think DIY investors, they can do it themselves. I say a lot of times, it doesn't hurt to have a part of your portfolio or some of your money in a robo-advisor, or some low-cost method, advisory service, right? Something that's done for you, that's hands-off, you don't have to worry about, and it is low cost. I think that's the important part, right? Which generally those robo-advisors are generally pretty low cost. Of course, you always need to be maxing out your 401k at work. That's often, a big part of that hands-off portfolio that you have, because it's all in funds, and it's really the best return you will ever get. It amazes me, people that are not maxing out the company match on their 401k plans, or even getting the tax benefits from contributing to an IRA, individual retirement account every year, right? But especially the 401k, if your company is matching even 30%, of what your deposits are, that is a 30% instant return. Nobody gets 30% instant return, right? And not Warren Buffett, not Peter Lynch, nobody. So if you get an instant 30% return from that company match, you get as much as you can. And it's a great way to have that hands-off portion of your portfolio, right? Because you're not generally buying and selling and trading out of those 401k funds. I would say that DIY investors, they have the tools available. They need to learn how to use them responsibly. Not get your investment advice from TikTok, not even get your investment advice from a lot of the YouTubers that have come up over the last couple of years that have no real experience in designing a portfolio for that long term. They're basically just investing in what's going up, and that's what they're telling people, to invest in what's going up, which always works until it doesn't. And we're seeing when it doesn't right now. So there are the tools available, and it's too bad that it's hard to tell everyone out there all at once, what tools they should be using, and what sources they should be listening to, because there is so much other noise out there. For the so-called experts, right? The people that have formal experience and training, we don't beat the market on a consistent basis either. Like I said, I have the vast majority of my wealth and my money in a hands-off portfolio idea, stuff that, is long-term investments I don't touch, I don't even look at on a month-to-month basis, because I know it's there, I know it's long-term, and I don't want to make those human decisions, those bad investor behaviors that affect all of us, no matter what kind of experience level. I don't want to make those in that long-term portfolio.
Well, Joseph Hogue, I wanted to thank you for coming on today. I feel like you really provided two important answers to questions I have. One is, a recession is coming. Should we do something different? And the answer is that we should have mapped out our goals a while ago, hopefully. We should decide what returns we need for those goals, and then we should toggle risk and reward in order to meet them. And maybe the first way to do that is have a written financial statement that elucidates what that is. That's point one. Point number two is, should we do something or should we stand still? A recession is coming. And maybe the answer is both. For 90% of our portfolio, it should be part of that written statement that's already been elucidated, and we should probably stand still with that. On the other hand, for that 10%, we can scratch the itch. We can go for the home run. Maybe we hit that home run. Maybe we strike out and whiff at that last strike. But either way, we'll be just fine. I want to end this episode the way I end every episode, by asking you what is up next in your life, and where can people interact with you if they want to know more? First and foremost, what is going on with Joseph Hogue?
Sure. Well, really, right now it is just I'm actually doing a podcast campaign where I am appearing on different podcasts and really trying to reach out to investors to lower the lower the energy level, or lower the stress level just a little bit, because as stocks do fall further, I see a lot of investors panicking, selling out of their stocks, making a lot of those bad decisions that we've talked about. So I just want to help investors change their perspective to understand that these are actually some of the best times you can invest. You make your money in a recession and in a stock market crash, right? That's where you make your best returns. So just stay calm and carry on investing, right? As they say.
And what's the best way to reach out and ask you questions, or if they want to learn more about you or your platform?
Sure. Well, I love it for everybody to come to the YouTube channel. Let's Talk Money and join the community there. I do videos usually about 3 times a week. I answer the comments, and we'll do a live stream every other week where I get to get that closer face-to-face connection with everyone and answer questions. So yeah, step by the YouTube channel, Let's Talk Money. I also have a blog called mystockmarketbasics.com. It's really a resource where I share not necessarily the stock picking and the trading and the strategies, but more that just the stock basics, right? The very core concepts of investing to make investing easy again for people to start and to keep investing, right? I think we overcomplicate investing. It doesn't need to be. There are just some core basics that if you get those right, that's 95% of investing success right there.
This has been the Earn and Invest podcast. On behalf of myself, Doc G, I'd like to thank Joseph Hogue.
Doc, great being here. Thank you.
That's a wrap. All right. I usually leave it recording just for a few minutes as we chat afterwards as part of the after show. Was there anything you think we didn't talk about? Anything that you were like, oh, I wish we hit this subject?
Oh, wow. No, I mean, it was really inclusive. I think there's like little details, questions that people have that we could have hit, but I think they're so granular that I mean, we went almost an hour, right? And I feel sometimes I kind of went on rambling. So, I think for brevity's sake, I think we hit everything. Things like the growth stocks. I think so many people are so new to investing over the last couple of years and have only ever invested in those growth stocks. They're seeing, a lot of them with portfolios down 80% even and 90% because of those growth stocks, because they're entirely invested in that. So, things like why you shouldn't only invest in momentum or growth stocks, how to invest in different sectors of the economy, different industries, different types of stocks. What's the difference between a growth stock and maybe more of a safety stock like utilities, consumer staples, and then what to do with those growth stocks. The fact that I think an important point is that yes, as these growth stocks have fallen 70, 80%. They are still the same growth company. So a lot of these, whereas last year the valuations were just ridiculous on these things, like SoFi, like Teladoc, 2 of my favorite growth stocks. The valuations were just ridiculous on them, and they have come down so much. But they are still growth companies, growing their sales at 20 and 30% a year. They're changing our lives, really, right? So, whereas. It sucks to be down that much, and it's going to be in the red for a lot of people for a long time, but don't sell out of them, because over the next 10 years, with valuations where they are now, over the next 10 years, they could be 15, 20% annualized return. So they're great investments now. Basically, they're the example of Amazon, right? In 2002, when it fell below $6 a share. From $100 in, I think 1999, it hit a peak of $100, fell down to less than $6 a share in 2002. A lot of people, exact same example, would have sold out because this growth stock isn't making me any more money anymore. It must not be a growth stock. Must not be a good investment. And $1,000 in Amazon 2002 would have been $500,000 right now. So $1,000 one stock. So just understand that a lot of these growth stocks that people are disillusioned with now are now actually the best investment you can have.
Yeah. Part of the problem is twofold, right? One is some people just don't understand the technical analysis to know that this is a great growth stock, right? That's part of it. Then the other part of it is some people just don't have the strength and courage to stick with it, even when it's doing crappy, even if they know technically it's a good stock or a good company. And so it's like, it's hard to have to be strong on both those points. And I think we see a lot of people, shooting themselves in the foot because of that.
Yeah, it's in the discipline of investing, and unfortunately, for so many people, for myself included, you only get that discipline through pain, right? So through those bad experiences, through the bad decisions, you learn from. Hopefully, you learn from them. The best thing you can do is learn from them and not make them in the future. It's just something we all have to go through. Investing since 1999. You've been investing just as long. We've been through these, and we know the bad decisions because we made them.
Because we made them, yeah. And we complained about them at the time.
Yeah.
What do you have? So, I mean, you have over 500,000 YouTube subscribers. What do you think the temperature of your subscribers is? Do you think they're feeling optimistic? Are they feeling pessimistic? Are they afraid? Are they excited? Is it everything?
Oh, afraid, still hopeful. I think I actually did a chart of the stock market cycle a couple weeks ago on the blog. A great chart, and it shows the chart. So the boom cycle and then the bust, and then with probably about 12 different emotions that investors go through. And on the way down, it is very, very much the stages of grief.
Yeah,
the 7 stages of grief, and I think we're still in that. In that denial stage for a lot of people where they're like, no, man, this can't be, this isn't what the market really is. The markets always makes me money. So some people are still in denial. Some people are even into the anger stage, right? Where they're blaming the government or blaming whoever they can blame, short sellers, whoever. We're not quite to that level of capitulation or just complete despondency, right? We're not quite there yet. We will be, within another 10%, I think people will be around there. But yeah, it is fear. It is disbelief, denial. It's all the usual emotions that people feel. And a lot of people, unfortunately for us, right, that have a business that evolves around traffic and views and things like that. A lot of people are getting to that point where they just don't want to even look at it anymore. They're either selling out of their investments completely, or they're just not looking at their investments and they're just tuning out, which sucks because views are way down and that and it's the wrong investing decision to take too.
Yeah, it's hard. I know. So on to the whole thing of being a content producer. Yeah, these are hard times because no one wants, like you said, no one wants to talk about it. Like our job is to talk about it, ups, downs, what to do, what not to do. And people do kind of like, I've had it, I'm done. Yeah. Which again, I'm lucky. I don't really, my content is still more for my enjoyment and pleasure than it is for making a living. So that makes it easy for me.
Yeah.
But I still feel that pain as I look at numbers and as markets go down. So
yeah, and it's too bad because you'll also get the comments that people that have only been investing for a couple of years and are used to stocks only going up and the stock pickers always being right. And now they're coming back with, oh, you said this stock was a good investment. You said this was a good company, and now it's down 20%, 30%. You're an idiot. Well, it's a good company, but everything is down right now. Okay.
Yeah,
everything's down 20 or 30, 40%. So it's a little bit that perspective and that framing as well. But it's just how it is. This is what we go through every 3 to 5 years, or in this case, 10 years, right? We really haven't had a good stock market crash in, since 2009. I mean, 2020 wasn't even really a crash. It was 23 days. So it really wasn't anything.
Yeah.